Check, 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 check. All right. Check one, two, two, two. I think you should be able to hear me. So let's jump into this. How about boom? Is that too loud? Too loud? Check one, two, two. Check one, two, two. Check two, two, two. We'll turn it up a little bit. How about that? See if that volume is nice. Medon no. How about now? How about that? Okay. We'll just go with it. So welcome to my first live video on my YouTube channel. A little bit of a rocky start, had to stop it and then restart it because we didn't know if there was volume or not, but I'm pretty sure we have volume now. So welcome to this first live video. We're going to be talking about a few things. We're going to be talking about, we're going to be going over some data from the Redfin data center. We're going to be talking about the jobs report this morning from the Fed. We're going to be talking about Hurricane Ian and the impacts on the real estate market. And I have a really great article from realtor.com. So let's not delay any longer. Let's jump on into it here. So first and foremost, I really hope this isn't backwards for you guys. But it shows backwards on my screen, but we'll just have to trial and error. And if it is, then, you live and you learn. So first off, we got the Redfin data center here. So we're looking at new listings. We're at a low point of new listings year over year compared to any of the past 3 years. As you can see here, 2022 is that black line. Only time really that we had lower listings was like right in the immediacy after the pandemic was sort of announced. And that's significant because it shows us that we're in turbulent times where people are less comfortable listing their homes. So pending sales we see are also down compared to 2020 and 2021. However, we do actually have more pending sales than in 2019, which is kind of interesting. But year over year, we're currently down 27.5% for pending sales. So, those high interest rates are really having an effect. Other thing I wanted to show you guys here, homes sold, we're at a low point compared to the last 3 years as well for sold homes. We are actually set, 20%, 20.8% down year over year at this point. So a lot less homes being sold. Again, high interest rates. And that's just kind of how it goes. And then wanted to show you guys last thing here. We have the median sale price. Well, maybe the last thing we see, despite, the less sales, we actually are still seeing that median sale price is higher than the last 3 years. And that's due to that, it's a direct impact of a lack of supply. Economics 101, low supply, high demand equals what? High prices. Exactly. So last thing I wanted to show you guys, last thing, days to close here. We see that we're actually more days to close. Year over year, we're actually down one, but more than what we were at in 2019, right? So you're about 25 there in 2019, about 26.7 now, right? Compared to the previous years, took about 27.7, right? So that's one less day now. So that shows you that there's still a lot of demand out there. Properties aren't sitting crazy long, but also there's very low supply out there. And then, a couple days less, 4 actually less. Is it 4? No, it's 2 days. Yeah, two less days year over year compared to 2020. So, things are sitting on the market similar amount of time, a little bit less. So it shows you demand is still strong. Okay. So something to keep in mind. Wanted to talk about the jobs report. Gosh, I hope this isn't backwards for you guys. Why does it look backwards? I don't know. Anyways, so wanted to show you guys this jobs report here. So coming out this morning from the Fed, America's employers slowed their hiring in September, but still added 263,000 jobs. So the estimate was about 250,000. So because there's more jobs than what was expected, that shows us and it tells the Fed that, hey, this unemployment is still low. Employment is still high. We're still adding jobs higher, quicker than we thought we were going to, which means that the economy is still strong, which means that the Fed is going to want to come in and stomp down on the economy a little bit harder with their steel-toed boots, and they're going to probably continue to raise their overnight rates, which is going to then ultimately impact mortgage rates by sending them higher again, right? So Friday's government report showed the hiring fell from 315,000 in August to the weakest monthly gain in since April 2021. Unemployment rate fell from 3.7% to 3.5, matching a half century low. So again, super low unemployment. Even though that hiring fell, it's still a very low unemployment rate. But the fact that the hiring is slowing a bit, I think, is a good sign. But like it says here, the Fed is hoping that slower job growth would mean less pressure on employers to raise pay and pass those costs on to the consumers through price increases, a recipe for high inflation. But September's pace of hiring was likely too robust to satisfy the central bank's inflation fighters. So what the Fed is trying to do is prevent a wage price spiral. Okay. So a wage price spiral would be where as employers are needing to continually raise the salaries of their workers so that they can, attract talent, keep talent, etc. That's going to cause those workers to then have more money in their pockets. So they're able to purchase things for a higher price, which means that companies are going to raise prices because as that demand increases and that, whatever, if supply, stays the same in this example, and the demand increases, then price is going to increase as well. As those prices of those goods increase, then the businesses have to pay their workers more. So that creates this feedback effect, this loop where, wages just keep going higher and higher and higher. Okay. So we don't want that. That's in the Fed's opinion, that's the worst thing that can potentially happen is a wage price spiral. So they're really trying to avoid that. Let's see. So in September, hourly wages rose 5% from a year earlier, the slowest year-over-year pace since December, but still hotter than the Fed would want. The proportion of Americans who either have a job or are looking for one slipped slightly, a disappointment for those hoping that more people would enter the labor force and help ease worker shortages and upward pressure on wages, right? So as more workers come into the workforce, businesses don't have to offer as competitive high wages because there's more people looking for jobs, right? So interesting to keep in mind. Let's see. The jobs report was still still too strong to allow Fed policymakers much breathing room, said Matt Perrin, director of research at Janus Henderson Investors. There was a couple other things I wanted to point out to you guys here in this article, which is here we go. So in this epic battle to rein in inflation, the Fed has raised its benchmark interest rate 5 times this year. It's aiming to slow economic growth enough to reduce annual price increases back to its 2% target. So the Fed is saying that they're going to do everything that they can to get inflation back to 2%. Now, as we see here, we're more at like an 8.3% in August, year over year. The CPI was 8.3%, right? The consumer price index showed an inflation rate of 8.3%. So that's a disparity of 6.3%. No bueno. And the Fed is willing to do whatever they got to do to make that get down to 2%, which I think could take a long time. And who knows if we will even get there. So there was here. So Fed Chair Jerome Powell has warned bluntly that the inflation fight will bring some pain, notably in the form of layoffs and higher unemployment. So it's not that they want layoffs and higher unemployment, but that is part of the recipe to bring inflation under control, unfortunately, for the people who are affected. Some economists remain hopeful that despite the persistent inflation pressures, the Fed will still manage to achieve a so-called soft landing, slowing growth enough to tame inflation without going so far as to tip the economy into recession. Well, we'll see. Personally, I don't have a lot of faith that that's going to go down exactly like that. Let's see. There was another thing here. No, I guess what was it? So that was it for that article. Next up, this was a really great article by Realtor.com. So props to Claire Trapasso for this article. The whole article is great. But I want to give you guys some certain little excerpts from it. U.S. Federal Reserve has completely upended the housing market, taking it from turbocharged to rapid deceleration. The effects of the Fed's rate hikes in its war against inflation are being felt in just about every crevice of the economy as recession fears are quickly mounting. I'm trying to highlight this so you guys can see it better, but the page is messing with me. The stock market keeps falling. Companies are scaling back or hiring or letting workers go. Scaling back on hiring or letting workers go. And mortgage interest rates are rising even more than anticipated, causing home buyers to slam on the brakes. All right. So home prices in many markets have even begun falling from their peaks. Now the question is, how far will they drop, and what fissures will be opening elsewhere in the economy to propel these changes? The red hot housing market will likely have to go through a correction as housing prices were going up at an unsustainably fast level. Jerome Powell, chairman of the Fed, said in a press conference last week. While economists debate whether the nation's already in recession or heading toward a downturn, it's clear that housing market has shifted dramatically. I think it's pretty clear that we're in a recession, even if after, I mean, they just finished their third revision. The Fed just finished their third revision of their numbers. And yeah, sure enough, we're in a recession. But some people say it's like, it's a technical recession. It's not really. I think it's pretty clear that we're in a recessionary environment, even if it's a mild recession. So the Fed is determined to cool inflation, and they're willing to throw housing under the bus to do so. When you raise mortgage rates to the point where they're at today, it breaks the back of housing. A year ago, homes were selling in mere hours as throngs of buyers tried to outbid one another by tens, if not hundreds of thousands of dollars over the asking price. However, when the Fed began raising interest rates, mortgage interest rates also went up, making it significantly more expensive for buyers to afford housing. Okay. So these would-be buyers aren't purchasing homes now. Sellers realize that they've missed the peak and they're holding off on listing their homes. Um, so many who need to sell are cutting their prices, right? So sellers that like actually really need to sell, they are realizing they're cutting the prices. A lot of sellers, they're looking around, they're like, well, my neighbor sold his house for $550,000 a few months ago. How is mine only worth 500,000 now? Well, that's how it works, you know. I mean, when the market goes down, it's hard for some sellers to realize that their house is no longer worth that high price. But some of them, if they don't really need to sell, they're going to like hold on for dear life that they get some magical buyer who wants to pay, the highest prices possible. But that buyer doesn't exist. Sorry. Because buyers thought the market crashed like 6 months ago, um, even though it didn't. So the deceleration in housing prices that we're seeing should help bring prices more closely in line with rents and other housing market fundamentals. And that's a good thing. This is also coming from his press conference from last week. It was actually 2 weeks ago. This article is a little bit older. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford housing again. All right. So, this is what the Fed wants. They want to bring housing prices down. Mortgage rates have been more than doubled in the past year, rising from an average of 2.87 this time last year to 6.7% for 30-year fixed rate loans in the week ending September 29th, according to Freddie Mac. Those higher rates have made monthly mortgage payments about 74% more expensive than they were this time last year. Okay. So going on here, buckle up, home prices expected to fall. Now, there's some things in here I don't necessarily agree with. There's some things I do. So we'll talk about it. So home prices are expected to fall whether the nation succumbs to a recession or not. Buyers simply can't afford giant price tags, plus the highest mortgage rates in 15 years. So I wanted to show you guys this real quick. So this is a historical map of interest rates here, right? So this is back in the 80s and like late 70s to early 80s. That's when you always hear like boomers and stuff be like, "Well, I bought my house. It's 17% interest rate." It's like, well, yeah, but median home prices were like $58,000. I don't know if that's the exact amount, but homes are like 10 times more expensive now. So yeah, okay, you had a 17% rate, but on a house that cost a tenth of what it costs now, when wages were like average, if average wages were like 45,000 back then, they're only like 58,000 now. So I'm kind of pulling these numbers out of thin air, but they're more or less like roughly at least commensurately accurate with what the numbers are. It might not be exact down to the dollar, but you get the point of what I'm saying. So that's when we had high rates. So if we bring this in, you can see now this is from like 2010 till now. So you can see how drastic of an increase in mortgage rates we've had in a short, very short period of time. So that's a big deal, ladies and gentlemen. Even if we bring this in to just the pandemic era, okay, so from like 2020, you can see, I mean, man, what a big difference in mortgage rates here. When we were sub 3% compared to now, we're breaching 7%, 7.0 for 04% yesterday on October 6th. So that's crazy, man. I mean, interest rates have just gone through the freaking roof. So there's going to be a coast to coast downturn in the housing market. It's going to be brutal, says Zandy. No part of the market is immune. Places that experience the biggest run-ups in prices in COVID-19 will be, with the most investors bidding them up further, we'll see the steepest declines. So this is one thing I don't agree with. In certain markets, yes, like Boise, Idaho, Austin, Texas, certain places that aren't always a tourist destination in terms of like second homes. Uh, yes, definitely those places are going to see big steep declines. However, where I'm at in Miami, yes, it's a tourist place. Yes, prices have gone up like almost 50% in the last few years. However, we still have more demand than ever, if anything. And so I think we'll see a decline here, but it's not going to be as steep as other places, even though it's one of the places that's experienced one of the biggest run-ups in prices. So I don't think this is a fully accurate statement. Vacation areas likely to see larger declines. Also disagree with that. Certain vacation areas, yes, like maybe Tampa, things on the west coast of Florida and stuff like that. But Miami is it's probably one of the hottest housing markets in the world right now. So I don't expect to see the same type of decline. Yes, we'll probably see one. Whether we see a recession or not, we'll probably see around 10% declines. If we start to see a real big problem with unemployment, then things could get a lot worse. But we'll cross that bridge. We don't hope for that. Obviously, if it happens, we'll take advantage of housing correction, but we don't want to see people lose their jobs in mass because that's not good for Americans. Pricing declines are going to happen, likely in the double-digit range. We may see pricing corrections similar to those that occurred during the Great Financial Crisis in certain markets. So in the Great Financial Crisis, we saw declines in some markets of up to like 40, 50%. I don't think it's going to be that extreme because we're not going to see the same amount of foreclosures and defaults and stuff like that. And also, there's not as much incentive for people to sell because most likely they've got a much lower interest rate locked in than than what they would be able to get. Because if you bought any time in the last 10 years, you probably have a lower interest rate than what you're going to be able to get now. So it's not a great incentive for people to want to list their homes, right? So this Zandy person believes home prices will fall by about 10% nationally over the next 12 to 18 months. I think it's going to be more than that. I think nationally it's going to be closer to like 18, 20%. If one, 18, 20, if the country avoids a recession. If one happens, he anticipates price declines could approach 20% from peak to trough in 2024. So that's more like, I think we're in a recession. So that's why I think it's going to be close to that 20%. Prices have come down quite a bit to make it affordable with these mortgage rates, right? So prices, they have to come down. If people are going to be able to afford the same type of house they were able to buy, last year or the year before, they can't do it on the same budget. A mortgage rate, a mortgage monthly payment is costing about $1,000 more than it was, at the bottom of mortgage rates, depending on the price of the home and a bunch of different factors. But just to give you a sort of rough idea. So, it's going to take some time. As I say, it won't come down immediately. Sellers won't drop prices unless they have to, especially as they watch their neighbors' homes sell for record prices just a few months earlier, while about 19.5% of sellers cut prices in September, a percentage that has steadily been ticking up. The majority of sellers have held firm. Like I was saying, they're looking at their neighbor like, well, Jimmy Joe just sold his house for $550. Why can't I sell mine for $500 or for $550? Why is it you're telling me it's worth $500? Well, because that's the market value. The market changes. It's just like, I don't know. Let's just take like Disney stock was trading at like 180, like less than like about a year ago. Now it's at like 100. Prices for things change. Like, I don't know what to tell you, bro. Like, that's the free market. You know what I mean? So, yeah, that's pretty much it for this article. Oh, and yeah, this was actually one last little thing. Like, don't expect a wave of foreclosures because buyers are more qualified than they've ever been. We've gotten rid of some of those predatory loan practices, etc. Also, silver lining for buyers grappling with higher prices and rates have been more homes are now on the market. Inventory was up 26.9% in September compared to the same time last year. So that is good. But the inventory is up because there's less sales, not because more people are putting their homes on the market. So, that's something to keep in mind. Now, last thing that I wanted to kind of go over here with you guys. My videos always go way longer than I think they're like. I thought this was going to be a 10-minute video. Here we are at 20 minutes. I love it though. So for Florida real estate that survived Hurricane Ian, a price bump awaits. So like I said, I got a video coming out on Monday that's going to be a deep dive into Hurricane Ian impacts on real estate, as well as looking at historical price action after hurricanes. But this article goes into a little bit of that too. I'll skip some of the basic stuff about the hurricane because probably y'all know like a little bit about what happened, right? So what I want to show you here is a study by Vero's real estate provider residential property evaluations to the real estate industry showed that property prices jumped by an average of 7% above the national average in 5 metropolitan areas hit by major storms during subsequent 12 months. So we see Hurricane Katrina. Obviously, everyone knows that hit New Orleans. You see there was 109% over the national average, or 109% of the national average, rather, versus 97% the year before, right? So the year after the hurricane, prices went up more. Hurricane Harvey, I believe that hit in Texas area. So you can see again, it was over the year before the amount of appreciation. Hurricane Andrew, that was a famous one that hit South Florida, same thing. Hurricane Charlie, I think that hit somewhere in Florida, I believe. So that one also, again, same thing, crazy price depreciation. And then Hugo, I don't remember where that hurricane hit. I want to say Atlantic coast, like Carolinas and stuff. Correct me in the comments if I'm wrong. But yeah, that's kind of what's going on there is that usually places in hurricanes, disaster zones, the prices tend to go up more the year after the hurricane. Now, why does this happen? They talk about it a little bit in this article. So, do 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 do. Well, basically, so the reason why it happens is because there's less supply, right? It all goes back to supply and demand. When there's low supply and high demand for real estate, then you're going to see prices go up. It's economics 101. It's the same thing that we're seeing right now with, even though that there's a decent amount of demand, because there's less supply in the market, we still have high prices. Same thing with hurricanes, guys. You can't escape economics 101, okay? Even if you opted out of that class in school, it's still affecting the world around you. So yeah, it's important to keep in mind that, probably we're not going to see prices go down after the hurricane in those areas. We're actually probably going to see them year over year go up. But I go into more detail about this in my video, and it's not quite as simple as that. So make sure that you subscribe so that you can check out that video on Monday. Ring the notification bell so you don't miss it, because I do a deep dive. It's an evergreen video too. I think it'll be helpful for people at any point in time wondering, about what the effects of hurricanes are on real estate. So that's it for this live video. It wasn't so bad. I enjoyed the live format and energy and so forth. Hopefully you guys enjoyed it. Thank you to the people who tuned in. And yeah, make sure before you guys go, if you aren't already, subscribe to the channel. Why not? Cost you $0.00. Ring the notification bell so you don't miss any videos like this in the future. And smash the like button, leave a comment. Whatever you can do helps me out with that wonderful YouTube algorithm. And that's about it, guys. Hope you have a fantastic weekend. Happy Friday. Stay safe out there. Take care of yourselves. Take care of each other. And yeah, Jake Fletcher here with the Fletcher Group at eXp Realty right here in Miami, Florida. And all my contact info is down below if you guys need the help of an expert realtor in the area. And reach out to me anytime. I look forward to helping you out. I'll catch you on the next one. Peace.